Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at TWST Bioscience.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. I think the core story here, the main narrative, is about a fundamental transformation that's happening at the company.
Right. For years, TWST was that classic high growth but high loss kind of story.
Exactly, a platform company. But now the whole mission has shifted. They're trying to turn this tech powerhouse into a self-sustaining, profitable growth model.
And that's the profitability inflection point. It's really the most important thing for investors to watch right now.
It is.
And if you look at the financials from their recent full fiscal year 2025 results, the numbers really suggest this is actually happening. Revenue climbed up to what? $376.6 million?
Yeah.
Which is a solid 20% year-over-year growth.
And that top-line number is great, it's necessary, but it's not the whole story.
No.
The revenue is healthy, but the real insight, the key takeaway, is that gross margin expansion. This is the metric that validates their entire operating model.
Yeah.
We saw the gross margin just jump dramatically. It went up about 800 basis points for the full year, hitting 50.7%, and it even crossed 51% in Q4.
800 basis points that's massive. To put that into perspective for you, that's not some small adjustment. It's proof.
Right.
It's proof that their manufacturing process, their proprietary tech, is hitting those critical economies of scale. And when you get that kind of leverage, every new dollar of revenue is just dramatically more valuable.
It is. It confirms the whole thesis that the technology was designed for mass production, and all those capital investments from years ago are finally paying off.
And what makes it even more compelling is what they're doing on the spending side.
The operational discipline. It's been incredible. They've kept operating expenses roughly flat for 3 straight years.
That's the key. That's what makes the margin expansion so meaningful, right? You have all this high-value revenue coming in the door. And because of the discipline on OpEx, they're just maximizing how much of that flows down to narrowing their losses. It's a very smart strategy.
And you can see the impact on the bottom line. It's tangible. The adjusted EBITDA loss narrowed substantially in FY25, down to $46.9 million.
Wow.
That's a $46.6 million improvement year over year. It just shows they're not just riding market growth. They are actively optimizing the business.
Okay, but the adjusted EBITDA loss is still almost $47 million. The trajectory is fantastic, we see that, but we know the market only really rewards sustainable businesses. So what's management promising on the break-even goal?
They've set a very clear, very specific target, and this is what I think investors are going to track relentlessly over the next year.
Okay.
They're aiming to achieve adjusted EBITDA break-even as they exit the 4th quarter of fiscal year 2026.
That's a huge psychological milestone. If they pull that off, if they actually become self-sustaining, the market will have to re-rate this stock. So what's the forecast to get there? What are the KPIs?
So for fiscal year 26, they're guiding revenue to between $425 and $435 million. That's about 13 to 15.5% growth.
Solid.
And crucially, they expect that gross margin to climb even higher. The guide is above 52%.
So that's the formula.
That's the formula. If they hit that 52% margin target and hold the line on OpEx, they get to break even. It's almost a binary outcome tied to those numbers.
Okay, so the financials are working, the discipline is there. But for this to be sustainable in a field like synthetic biology, you need a deep, unassailable tech moat. And this brings us right to the reason those margins are expanding so fast, the platform.
That's right. If you connect the dots between that 800 basis point jump in the platform, the moat becomes crystal clear.
Yeah.
It's their proprietary silicon-based DNA synthesis technology. Traditional methods use columns, which are just inherently inefficient and expensive to scale. TWST uses silicon chips, and it fundamentally transforms the entire manufacturing landscape.
How can we make that relatable for you listening? Is this like going from handwriting a note to using a high-speed industrial printing press, but for DNA?
That's a perfect analogy. The old column method is like sending one letter at a time. It's sequential.
Yeah.
The silicon platform is like printing hundreds of thousands of letters all at once on a single chip. It allows for extremely high throughput, low cost, and, this is key, high accuracy oligo and gene synthesis.
And that tech advantage is showing up in their business segments. Their biggest one, NGS next-generation sequencing, is really capitalizing on this.
Absolutely. NGS revenue grew 23% year over year to over $208 million. And the demand for high-value sequencing workflows, for things like cancer diagnostics or personalized medicine is just huge.
So they're feeding the engine.
They are supplying the raw materials for the genetic revolution.
And it's not just tools. The biopharma segment, which is more about drug discovery, that's also showing some real momentum. And that feels like a much stickier relationship.
It is. Biopharma revenue was up 22% year over year in the fourth quarter. It's smaller, yes, but it's so important because it generates a growing royalty and milestone pipeline.
So their tech isn't just a one-off purchase. It's becoming deeply integrated into the customer's R&D pipeline.
In therapeutics and diagnostics.
Yes. And that embedding into workflows, that's what creates the high switching costs we're always looking for. Once a pharma company validates their entire development process on Twist-specific reagents, they're not going to switch to save a few bucks.
Exactly right. The time, the cost of revalidation, it far outweighs any potential savings.
And how do we know this is real? What's the outside validation?
You look at the strategic partnerships, collaborations with big players like Ildong Pharmaceutical for immuno-oncology or Ginkgo Bioworks, a giant in synthetic biology. These aren't just marketing stunts. They're proof that the most demanding customers in the world rely on their platform for mission-critical work.
So they're becoming this indispensable partner for the whole AI-driven drug discovery world. Okay, before we get to the risks, let's just touch on the financial cushion. They're spending to grow. They're still losing money.
Yeah.
The balance sheet has to be strong.
Great point. They ended the fiscal year with about $232.4 million in cash and short-term investments. That's a substantial cushion.
So that's the runway.
That's the runway. It supports their self-funded path to break even. They used about $47 million in cash for operations over the last year, but with over $230 million in the bank, they can execute their plan even while spending on essential CapEx.
Like the Oregon facility.
Exactly, like the $28 million they spent in FY25, which included that big expansion.
Okay, that's the bull case. Proprietary tech, high margins, major customers, and a clear funded path to profitability. But every investment has risk. So let's talk about the bear case, because this stock is still volatile.
The main risk is, and I think it's still, execution risk around that break-even target. The improvement's been dramatic, but they are still loss-making.
So what happens if revenue growth slips?
Well, if it slows below that 13 to 15% guide, or if some manufacturing issue stalls the gross margin below 52%, that break-even goal gets pushed out. And as soon as that happens, the market's focus snaps right back to cash burn.
Right. You call the CapEx self-funded, but if execution falters, that might not be true anymore. How comfortable should you be that they won't need to dilute shareholders again if there's a slowdown? I mean, that $47 million cash burn last year is not small.
It's a genuine concern, and your comfort level really comes down to your confidence in management hitting that 52% gross margin. At 50%, they still need a lot of leverage. But at 52%, if they hold OPEX, they eliminate the cash burn by Q4 FY26.
But if they miss?
If they miss, the risk of dilution comes right back on the table, and that's why the stock is so sensitive to any negative news.
And it is notoriously sensitive. We've seen it play out. I mean, we have to talk about the short seller report that caused that staggering, 20% slide?
Yeah.
They were comparing the company to non-substantive businesses. That kind of reputational hit, it lingers.
It does linger, and that market fragility is a key factor here. Even recently, we saw skepticism pop up over, what seemed like routine things, like the recent CFO share sales, which caused an immediate 4% drop.
That's a hard sale.
In a healthy market, that wouldn't even move the needle. But for Twist, the sentiment is fragile. Investors are just quick to punish any perceived weakness.
Okay, so let's give a robust rebuttal to that negative narrative. The short seller claims, what evidence do we have now that proves this is a real high-value business?
The evidence is overwhelming, and it just fundamentally contradicts that bear thesis. First, audited financials. You have sustained 20% growth and 50+% gross margins. You don't get that kind of leverage without real tech assets.
Right. And second,
the partnerships. That's the definitive proof.
Yeah.
Firms like Ildong and Ginkgo Bioworks do deep due diligence before they embed their R&D programs onto your platform. You just don't partner with a non-substantive business.
And finally, the tangible assets. They're actually building things.
Exactly. They are putting hundreds of millions into real manufacturing capacity, especially with the Oregon facility expansion. This is a massive real-world investment. It completely contradicts any of those old claims.
And a lot of that fear seems to be priced in now.
I think so.
Which brings us to the technical setup.
Yeah.
Despite all this fundamental improvement we're talking about, the stock is trading in the mid-20s.
Yep, right near the lower end of its 52-week range, which went from 24 all the way up to 55. And technical analysts are pretty much all calling this a basing pattern or an accumulation zone.
Meaning the downside risk is priced in.
It suggests that the market has already factored in a lot of that risk, from past stumbles to that lingering sentiment. The technical floor seems pretty strong.
So if the downside is arguably capped, what are the catalysts? What are the events that could drive this thing higher over the next year?
The nearest big one is the earnings report in early February 2026. That's for Q1. Investors will be laser-focused on whether they hit that $100 to $101 million revenue guide.
And the bottom line.
And, more importantly, can they show visible progress narrowing that EBITDA loss? They have to prove they are on track for that break-even target. Execution is just non-negotiable now.
Beyond earnings, you've got the product pipeline, right, at the industry conferences where they can show they're not just selling more of the same stuff.
Absolutely. The upcoming healthcare and life science conferences are huge platforms. We'll be looking for product updates, probably around things like MRD Express for cancer diagnostics or their expanded antibody discovery offerings.
And if they show customer traction there.
It generates immediate upside sentiment. It validates the future growth story.
And we can't ignore the macro environment. This is still a high beta stock. It swings.
It really swings. The beta is around 2.37. So if we see the macro backdrop improve, better risk appetite, maybe from rate cuts next year, and you see sector rotation back into synthetic biology and AI-enabled drug discovery, this stock could benefit disproportionately. Its valuation is so depressed from its highs, it's like a coiled spring if sentiment turns.
All right, let's talk optionality, the speculative stuff.
Yeah.
The lottery tickets that aren't core to the thesis, but could unlock some surprise value for you.
There are two that always come up in the research. First is the DNA data storage unit. It's inside TWST right now, but there's always speculation that a spin-out or a strategic partnership could unlock hidden value.
If that market takes off.
Exactly. It's an option, but it's a potentially huge one.
And the second one?
The strategic acquisition angle. Given their unique platform, their scale, their deep integration in biopharma, there's always chatter that TWST is a prime acquisition target.
For who? A larger life science tools firm.
Or maybe a major pharma company that wants to vertically integrate its R&D. If TWST hits that profitability inflection, they become an incredibly attractive, irreplaceable asset. You'd be buying market share and a proprietary scaled platform.
So if you pull this all together, the numbers, the moat, the risks, the catalysts, what's the final takeaway for someone looking out over the next 1 to 2 years?
I think TWST presents a really attractive risk-reward profile right now. This is a classic profitable growth inflection trade. And the thesis is now supported by hard-audited financials.
Right.
You've got margin acceleration, a clear path to being self-funded, all backed by a strong tech advantage. The targets are clear, and they seem achievable.
Yeah, that fundamental improvement, that jump to 50% gross margins while keeping expenses flat, it makes the stock worth a hard look right now, despite the past volatility.
Yeah.
The price is near its lows, but the fundamentals are arguably the strongest they've ever been.
It's a compelling disconnect.
It really is.
The time to accumulate is often during these basing patterns, before the profitability is confirmed and everyone piles in. The key for you listening is to focus ruthlessly on those Q1 and Q2 FY26 numbers, gross margin and EBITDA. If they hit those, the market is going to correct this valuation gap.
We'll be watching that Q1 report very closely. If you want more analysis and updates on this sector, make sure you subscribe to Smart Wealth with Joshua. We're here every day.